Hey, ACC 202 students, welcome to your ultimate exam survival guide. If you're staring down the barrel of week 7 and feeling a little lost in the weeds of accounting standards, you are in exactly the right place. This explainer is designed specifically to demystify this week's dense, highly technical material. We're going to cut right through the noise and focus exactly on what you need to understand to pass and excel in your upcoming assessments. Look, I completely acknowledge the pain point you're probably experiencing right now. Your lectures and textbooks are just packed with technical jargon, constantly referencing ASB 132, 9, and 7. Honestly, it can feel like you're trying to read a foreign language. But don't sweat it. I'm going to be your translator today. We're going to take those complex standards and break them down into plain, actionable English.
Here's our quick 5-step roadmap for today. We'll define the basics, unpack derivative instruments, tackle liability versus equity, look at compound instruments, and finally, master those ASB 7 disclosures. Let's get into it.
All right, Section 1, defining financial instruments, the absolute basics. Let's build that foundation. So this is the official definition from ASB 132. It sounds dense, but the absolute most important word here is contract. A financial instrument isn't just a pile of cash sitting in a vault. It's fundamentally a legal relationship. Think of it like a giant mirror. A transaction always creates a mirrored contractual relationship between two different entities. If you've got a financial asset, someone else on the other side of that contract must have a financial liability or an equity instrument. Let's break down that asset side, nice and punchy. Obviously, cash itself is a financial asset, but it's also holding an equity instrument of another entity, like owning shares in a company. Crucially, it's also the contractual right to receive cash in the future or to exchange financial instruments on favorable terms. Basically, if you have the right to get cash or you're sitting on the favorable side of a deal, you are holding the financial asset. Now let's flip it and look at the liability. If you take away just one phrase for your exam here, make it this: contractual obligation. If you're legally bound by a contract to hand over cash to someone else, or you're locked into an exchange on potentially unfavorable terms, boom, you have a financial liability. It's an inescapable commitment to an outflow of resources. And that brings us to the third piece of the puzzle, the equity instrument. This idea is actually incredibly simple, even though textbooks love to overcomplicate it. Equity is literally just the residual interest. It's whatever is left over in the assets after you've deducted absolutely every single one of the liabilities. It's the bottom of the barrel claim, carrying the ultimate residual risk. Now pay attention, because here's where examiners love to set traps for multiple choice questions. What is not a financial instrument? Well, why isn't a tax liability a financial liability? Because it arises from a statutory government requirement. It's not a voluntary contract. What about prepaying cash for a service? Well, that settles by delivering a service, not cash, or another financial instrument. If it lacks that core contractual financial risk, it is totally excluded. Don't fall for it. Moving right along to Section 2, unpacking derivative instruments, the 3-part test. Derivatives are a notoriously tricky area, right? But under ASB 9, we're going to frame it as a foolproof 3-part checklist. A derivative must hit all 3 of these characteristics. First, its value changes based on an underlying variable, like an interest rate or commodity price. Second, it requires 0 or a super small initial investment. And third, it settles at a future date. If your exam question describes a contract that hits these 3 exact steps, it's definitively a derivative. But examiners won't always make it easy by giving you a standalone derivative. Watch out for embedded derivatives. Think of these like financial Trojan horses. A derivative, like an option, can actually hide inside a normal host instrument, like a standard debt contract. This creates a hybrid contract, and you've got to be sharp enough to recognize when the cash flows of that combined instrument are varying just like a standalone derivative would. All right, Section 3, liability versus equity, where marks are lost. Put on your examiner's lens for a second. This right here is exactly where students trip up and lose serious marks. Messing up this classification cascades through the entire financial statement. If you classify an instrument as a liability, those periodic payments are treated as interest expense. That shrinks reported profit and hikes up leverage. If it's equity, the only risk is equity risk, the risk to the residual value, and payments are dividends, not expenses. Substance over form is everything here. Let's move to Section 4, compound instruments, convertible notes. So, what happens when an instrument has characteristics of both a liability and equity?
Enter the classic convertible note. When a company issues one of these, ASB 132 forces you into split accounting. You actually have to break it into two pieces at issuance. The liability component is the obligation to deliver cash for interest and face value. The equity component is the embedded option to convert that note into shares, but, and this is a massive exam key, that conversion must be for a strictly fixed number of ordinary shares. If that number fluctuates, it fails the equity test completely. And here is exactly why that split classification matters so heavily to the bottom line. The parts you classify as a financial liability, they generate interest or losses that punch right through the statement of profit or loss. But any incremental costs tied directly to issuing that equity component, those bypass the income statement entirely and are simply deducted straight from equity. It's a huge difference. We're almost at the finish line. Section 5, Mastering ASSB 7 Disclosures, the final step. Let's wrap up our theory with ASSB 7. Think of this as having two main pillars. First, entities have to disclose information showing the sheer significance of these instruments to the company's financial position. Second, they have to be totally transparent about the risks. For the exam, you need to know these three: market risk, credit risk, and liquidity risk. And importantly, how management is actually dealing with them. Okay, let's do a quick exam simulation. I want to test your knowledge with a real scenario pulled straight from your Week 7 practice solutions. Imagine a company, Merlin, issues Class A preference shares. These shares have a contractual, fixed future redemption date where Merlin must buy them back for cash. Think about it for a second. Is this a liability or is it equity? Got your answer? It's a financial liability. I know, they're called shares, which totally screams equity, but remember, substance over form. Merlin has a fixed contractual obligation to deliver cash. They have absolutely no unconditional right to avoid paying it, so it's a liability. And the crazy part? Any dividends paid on those shares will actually be recorded as interest expense. Tricky, right? I want to leave you with this final provocative thought as you jump back into your studying. We just saw how classifying an instrument as a liability reduces reported profit and hikes up leverage. Knowing that, how do you think these rigid accounting rules incentivize CEOs and investment bankers when they're designing shiny new corporate financial products? Mastering this stuff doesn't just help you pass ACC 202, it actually helps you decode real-world financial engineering. Good luck with your studies, you've totally got this.